So what does that mean from a rental point of view? Well, not surprisingly, the pattern that we've seen of some quite strong recovery in office rents. This measures prime office rents in major markets, so it's not the average of the market, it's the better quality end of the market. And you can see there was that recovery coming through 2010. In all regions of the world where we had seen some recovery in rental activity, almost all of them trending back to zero. Very, very little rental growth coming through anywhere in the world at the moment. And that's a pattern that we expect to see going forward, certainly over the next 6 to 9 months or so. I would simply point out again, just look at the synchronization between the regions, clearly different magnitudes of growth. Look at the synchronization. And again, when we turn to the capital value movements, very similar pattern. It's very evident that what's been happening to rents in the office markets has very much been driving what's been happening to capital values. We did see some sharp compression in yields in many markets through 2009, early 2010, as investors sought that prime real estate, which was seen suddenly as being actually quite a good defensive play in the face of very extreme global and political uncertainty. That effect has kind of washed through the markets, and as the rental growth has moderated across most regions, so similarly the shifts in capital value, again trending back to, these are quarter-on-quarter movements, trending back to pretty low levels, and in the case of Europe, just starting to decline. So from an investment market perspective, which is what I want to just focus on for the next few minutes, in terms of global transaction volumes, clearly there's some quarterly volatility, but you can see that actually there was a pretty steady trend of recovery from the bottom of the market in early 2009 up until the end of last year. Sentiment definitely was weakening from the middle of last year when a lot of the current crisis issues really blew up. But the volume of transactions held up. It's fallen away again over the course of the first 6 months of this year, but not to a catastrophic extent. It is still a feature of the market that in a number of cases that the total volumes are being supported by isolated very large deals, and if you look lower down at the standard volume of more typical investment transactions in the 50 to 100 million US dollar type category, then those are relatively subdued. So certainly a plateauing in the recovery that we saw. And turning to what's been happening in Asia from a transaction volume point of view, you can see quite a lot of volatility in the numbers over the course of the last 12 to 18 months. Here in particular, we have seen a number of very large deals, some portfolio deals or some big single asset deals in the case of Hong Kong, which have shifted the numbers, which are driving the volatility. In general, sentiment certainly is slightly weaker than it has been, but there is still activity happening. Relative to what we saw in the low point of the market, actually there is perhaps a surprising volume of activity. This graph differentiates between domestic investor activity and cross-border. The cross-border activity is shown in green, in the light green at the bottom. And what you can see is that apart from that spike around the end of the year, cross-border activity had been particularly high in the pre-GFC period. It then fell away, and typically we've been seeing somewhere between 15 to 20% of activity across the region driven by cross-border investors, as opposed to the 20% to even up to 30% in the pre-GFC period. Now, this is perhaps to be expected in times of caution and uncertainty. There's a natural tendency for investors to just be more careful about cross-border investment into markets that they probably know slightly less well. And we do expect cross-border activity very much to pick up again once we get back into not a 2006-07 period, but a rather more natural and confident environment. But trying to unpick some of the issues in here, and particularly focus in on why this is relevant to Australia. If we look at total investment activity over the last 12 months, differentiated by market, and doing the same thing, looking at cross-border versus domestic, there are two things that come through. The first is that in the previous 12 months, certainly during the GFC, a lot of the cross-border activity was being driven by global capital coming into the region from outside. Since the financial crisis, it's actually been Asian capital moving around, or Asia-Pacific capital moving around the region, that has tended to dominate cross-border activity. The second factor that's quite evident here is that Australia has attracted a high proportion of the cross-border investment that has gone on, and the dark green bars here are money coming into the region from outside. This is not Asian money moving around, it's international money, global money coming in. Classifying capital by nationality is becoming increasingly difficult, but so far as we can identify, what you can see is that a third of all of the money that has come into Asia Pacific over the last 12 months from outside the region has been focused here in Australia. And one of the marked things that I find whenever I come to this market is that although people recognize that there are challenges here, actually sentiment around the Australian market seems to be, if anything, stronger outside the region than it is here. Just turning back to total investment activity, this chart looks a bit complicated, apologies for that, but it shows two things that I think are quite important. The top bar in each case is investment activity in the last 4 quarters, the last 12 months. The bar below it is the year to June last year. And we've split it out by country and by sector. Firstly, you can see that although Japan is a very large market, as we saw in the previous slide, it's actually very difficult for international investors to penetrate. The Australian office market, the second most active national sector market that we've seen in the region over the last 12 months, but also quite an important shift in terms of sector focus. Because you can see just slightly lower down, there are 4 bars here where the light green bar is significantly bigger than the dark green. That's where investment activity has fallen, and the 4 dominant ones are China offices, Hong Kong offices, Singapore offices, South Korea offices. The sectors that had been the most active during 2010-11, actually seeing less activity, partly because the good quality investment product that investors are really looking for has been less available, partly, as we'll see in a second, because of concerns over the pricing that people are currently having to pay to target those core prime office products. And indeed in China, if you have a look at these numbers in a bit more detail later, what you'll be able to see is that in fact the China office market in particular has seen quite a sharp reduction in activity. Chinese retail sector has seen a sharp increase, so that the balance of investment activity across the two is now pretty similar. Quite a big difference and a big movement there, and it's all down to that product availability and pricing. Where's the capital coming from that's influencing our markets? The answer is it's either coming from, or in many cases through, Singapore. Quite clear that Singapore has emerged as a really fundamentally important hub for the movement of capital into and around the Asian markets. It's not just the sovereign wealth funds. The Singaporean REITs have been very active, and indeed they've been very active here in the region, here in Australia, excuse me. And the 2 other big sources of capital that we've seen moving cross-border have been Chinese money and Hong Kong money. But if we drop down just a level and look at the combination of where the money's come from and where it's gone to, in fact, that China-Hong Kong issue is a lot of money flowing between the two. If you look at the top bar here, China, which has seen most money, and this does exclude purchases of development sites, which is a huge separate sector. But in terms of standing investments, fully a third of all the money that's gone into China has actually been Hong Kong capital. And you can argue about whether or not, in fact, that there is a huge amount of distinction there. Similarly, if you look at the Hong Kong market, the vast majority of the international money coming into Hong Kong has been from China. And that leaves Australia standing out for 2 reasons. Firstly, simply the volume of investment that has been coming cross-border into the market. But secondly, look at the number of different colours there. You've got Taiwanese capital, European capital, UK money, Chinese money, a huge diversity, and indeed the larger proportion of what we would call global capital has actually come into Australia. So a huge amount of interest in the markets in this region.